For week 3, we are going to cover 2 distinct topics. The first is investments, and then the second is revenue recognition. And you may be aware that at the beginning of 2018, there actually was a new revenue recognition standard that came out, and so we'll talk about what that standard is and how it's different from the old standard. So our key topics for this week are going to be a discussion over investments in debt securities, then investments in equity securities. We'll also talk about a couple of investment reporting issues that we need to consider, and then we'll move into revenue recognition, where we'll go over the 5-step revenue recognition process. We'll talk about accounting issues related to revenue recognition, and then we'll finish up with a discussion over presentation and disclosure. This week's material also covers how to account for long-term contracts, but I'm going to go through that step-by-step process in a separate video because there's an example that I want to walk through, so I'll put that in a separate video for you to listen to. So, first of all, we need to think about why might a company want to invest in other companies? And there's a number of reasons why. One is to earn a high rate of return. So, depending on the type of instrument that a company might invest in, they may receive interest revenue if it's a debt instrument, or if it's an equity instrument, they might receive some type of dividend revenue on a periodic basis. Now, a company might want to invest in other companies if they don't have any good use of cash internally. Obviously, first and foremost, a company is going to, reinvest in itself if it makes sense to. That could either be by, expanding production, opening up a new production line, adding a new warehouse, or capacity, upgrading its machinery, all sorts of things like that would be, internal uses of cash that could either enhance efficiency or effectiveness of whatever it is that the company is building or producing. But at some point in time, right, there's no good use of in cash internally, especially if the company can generate a large amount of cash from operations. And so then companies start to look at what is the next best use of cash. Some companies like to invest in other companies in order to help decrease their overall risk. You often hear about the importance of diversification, and so by taking money and investing it in other industries, you help to diversify risks due to economic, political, or social considerations that may at times be detrimental to the industry in which your company operates. It also can be a strategic decision, and that is to say that by investing in either an upstream or a downstream company that your company relies upon, that they may be able to secure certain operating or financing arrangements. So if you think about it, Coca-Cola and Pepsi at their core, right, are beverage manufacturers, and Pepsi does more than just beverages. They also produce a wide number of snack type food items. But we also know that Coke and Pepsi don't necessarily bottle their own soda for eventual distribution, right? There are independently owned and operated bottling manufacturers that do that. Well, even with that said, there is an advantage to Coke or to Pepsi having an interest in those bottling companies, because without those bottling companies, that Coke and that Pepsi product is not going to reach the shelves and make its way to the ultimate consumer. It's also a way for companies to exercise some control over, another company's operations, especially if they own a significant portion of the company. So with all that said, how we account for these investments depends on two main factors. The type of security that the investment is, and for the purposes of our class, we're going to talk about debt investments and equity investments. And then the second important point is the intent, and that is what management plans on doing with the investment. And when we talk about intent, what we're talking about really is, are they going to hold on to it until maturity? Are they trading it in the short term? Or is it neither one of those two? And so we'll go through the different definitions that are possible in just a minute. So let's start first by talking about investments in debt securities. So an investment in a debt security is when a company enters into a creditor relationship with another entity. This can include things like U.S. government securities, municipal securities, corporate bonds, convertible debt, and commercial paper. And so a good example are like U.S. government securities and municipal securities. So, the government or cities, right, issue debt. So companies or in other parties, right, will give the city or the government money, and in return, right, they get periodic interest payments, and then at the maturity date of that debt, they're going to be paid back. So when you think about investments in debt securities, 2 weeks ago during week 1, we talked about debt as if it was the company that was issuing the debt, therefore receiving the cash. Now we're looking at it from the opposite side, whereas the company is giving up cash to another company, so that other company is the one that's taking on the debt, and now from the perspective of looking at it from the company, we're the ones that are going to be collecting those periodic interest payments and then collecting the cash at the maturity date. So when we talk about investment for debt securities, there are 3 possible categories for the accounting and reporting. The first is called held to maturity, and this is a debt security that the company has the positive intent and ability to hold to maturity. And what that really comes along to is the company doesn't need the cash, right? So it decides to enter into a debt security, give that cash away for a period of time, and they're fine not needing that cash for the duration of the a note, and they're going to have sufficient cash flows in the meantime. The second type is a trading security, and those are debt securities that are bought and held primarily for sale in the near term, and the reason that is happening is because the company thinks that they can generate income on short-term price differences. And then finally, we have the third category, which is called available for sale, sometimes known as AFS. And those are securities that basically don't fall into the classification as either held to maturity or trading. So this chart here basically summarizes how they're going to be valued on the balance sheet, and then also what happens with their periodic fair value updates and when income is earned and recorded on the income statement. So held to maturity securities are going to be valued at amortized cost, and that's your acquisition cost adjusted for any discount or premium. So when we went through week 1 and we looked at debt securities then, we were primarily assuming that those debt securities were held to maturity because what we were recording them on was an amortized cost basis. Now, as the value of that security changes over time, we do not recognize any of those unrealized changes into a financial statement. And then when interest is earned, so if it might be periodic interest earned on a semi-annual basis, we will record those periodic interest payments as revenue. And then finally, when we settle the debt, so at the maturity date, any gains or losses would be recorded at that point in time. For both available for sale securities and trading securities, they are valued on the balance sheet at fair value. So basically what they would be trading for on the open market. Where they differ then is when it comes to unrealized holding gains and losses. So I'm actually going to start with trading securities first. So I mentioned on the previous slide how for trading securities, the purpose or the intent of those securities is to potentially generate short-term gains or income basically from price differentials. And therefore, changes in the fair value on an unrealized basis, because we still hold on to the security and we haven't sold it yet, are actually recognized into net income on an ongoing basis. That differs from available for sale securities, in which you are going to recognize unrealized holding gains and losses, but as a component of other comprehensive income, which is goes into stockholders' equity, as opposed to the income statement or the P&L, which is where trading securities get their unrealized holding gains or losses recognized. And then, regardless of whether or not it's an available for sale security or a trading security, interest is going to be recorded when earned, and gains and losses will be recorded upon the eventual sale. So held to maturity securities can only ever be debt securities. And the reason for that is because equity securities have no maturity date. If you go out and you buy a stock, you could hold that stock forever if you wanted to. Right? There's no end maturity date for stock, and therefore equity securities can never have a held to maturity designation. In order to be classified as held to security, you have to have both the positive intent and the ability to hold the securities to maturity. Positive intent means it's management's plan or strategy to hold on to them, and ability is that there is no other need for that cash during the period of time that this debt security is supposed to be outstanding for. So at the bottom here, I have just showed a brief example. And so this is Taylor Swift has purchased $100,000 of 8% Calvin Harris bonds on 1/1/2014 at a discount, paying $92,278. The bonds mature on 1/1/2019, so they're 5-year bonds and they yield 10%. And interest is payable semi-annually on July 1st and January 1st. So back in week 1, we would have recorded this entry from the perspective of Calvin Harris, right? Calvin Harris was getting cash. Calvin Harris was reporting a liability on the balance sheet. But in this week, we're looking at it from the opposite side. We're looking at it from Taylor's side, and we're looking at it as she's paying out cash, and what she's getting in return is an investment, an asset that's going on the balance sheet. So she is going to record a debit to debt investment for $92,278, and she is going to credit cash for the same amount. Okay, so the interest revenue table then for the investor, so in this situation, Taylor Swift is the investor. You'll notice that this looks very similar to the tables that we had in week 1. The only difference here, though, is that instead of it being cash paid and interest expense, we now see cash received and interest revenue. So what you'll notice here then is each semi-annual period, she's going to receive cash of $4,000. That cash is going to go as a debit and increase the cash balance on the balance sheet. She's going to record interest revenue. It's a credit that's going to be on the P&L. And then the final thing that you're going to see happen is she's going to amortize her discount, and that's going to be necessary because by the time that this loan gets to its maturity date, which is 1/1/2019, the value of this note or bond or the value of this investment, this debt investment, is going to be $100,000, and that's the amount of cash that she is going to receive back from Calvin Harris. This slide basically just goes through the mechanics of the calculation. Keep in mind it's the exact same as what we talked about in week 1. It's just opposite thinking, because instead of cash paid, we're looking at it from the other perspective, the perspective of the investor or the issuer. And so it's cash received and it's interest revenue, not interest paid and interest expense. These are just the journal entries that you're going to see, and then also what the balance sheet and income statement is going to look like at the end of the year. Now keep in mind that the interest receivable is going to be classified as a current asset, and that's because that payment is going to be made on January 1st, and as of December, a receivable has been reported, and it's going to be received within less than a year, which is why it gets current asset treatment. The long-term investment, which is our debt investment, is going to be sitting in long-term because we know that maturity date is not until 2019, which is more than a year out, so it's going to get long-term status. It will transfer to short-term when we get to 2018. So next up is available for sale securities. So as the summary indicated, available for sale securities are going to be reported at fair value, and we are going to record any unrealized gains or losses related to the changes in that fair value in an unrealized holding gain or loss account, which, as I already mentioned, is a component of other comprehensive income within stockholders' equity. We do not report for available for sale securities any changes in fair value into net income until the security is sold and that unrealized component becomes realized. So if we look at an example here, Blake Shelton purchases $100,000 of 10% 5-year bonds on January 1st, 2014, with interest payable on July 1st and January 1st. The bonds sell for $108,111, which results in a bond premium of $8,111 and an effective interest rate of 8%. Okay. So Blake Shelton is purchasing these securities. So our entry is going to be a debit to debt investment of $108,111 and a credit to cash of $108,111. Okay. Here is going to be our interest revenue table for the investor or the issuer. Okay, you'll notice that by the end of the 5-year period, we got to $100,000. Okay, our journal entries are going to look as follows. So we're debiting cash, crediting the debt investment, crediting interest revenue. Okay, so now what happens? So those are the entries that we booked throughout the year. How do we apply the fair value measurement at year end? So at year end, we're going to assume that the fair value of the bonds is $105 and that the carrying amount of the investment is $106,733. So if we come back here, okay, at the end of 2014, which is the very beginning of 2015, you'll notice that the carrying amount of the bonds is $106,733. Okay, that's the carrying amount. So that's what's currently on the balance sheet. Okay, however, for available for sale securities, we need to adjust them to fair value at the end of each year. And we are told that the fair value is $105. So in this situation, the carrying value is greater than the fair value, and therefore we need to record an unrealized loss. That journal entry is going to be a debit to unrealized holding gain or loss dash equity, and that account is going to roll up into other comprehensive income, which is a section within the stockholders' equity portion of the balance sheet. And then the credit is going to go to fair value adjustment, available for sale. The reason that it's going to go to this account is twofold. One, we wanted to note that these are available for sale securities, not trading securities. And number two, this fair value adjustment account, think of it as similar to an allowance for doubtful accounts. Right? It's a contra asset account, and the reason that we want to credit it instead of crediting our debt investment directly is because we want to be able to see kind of what the historical carrying amount of the debt investment was and what fair value adjustments we have made. Now, it is possible to net any unrealized gains against unrealized losses of different securities and report a net number if you happen to have a portfolio of securities. Now, what happens when you sell your available for sale securities? So, new example here. Adele sold Miley Cyrus bonds on July 1st, 2013 for $90,000, which had an amortized cost of $94,214. Okay, so for this particular example, let's pretend that we had no unrealized loss on this this available for sale debt security. Let's also assume that the amortized cost and the fair value are the same. So what we're going to do is we are going to debit cash for $90,000, credit our debt investment for the $94,214, and then as a result of this we have a loss on the sale of the investment, and that's going to be a credit to loss on sale of investment. That loss on sale of investment will roll up into the other expenses and losses section of the income statement. Then finally, trading securities. So for trading securities, the purpose is to generate profits from short-term differences in prices. In this situation, if we have an example where the Rolling Stones determine that its trading securities portfolio has an amortized cost of $314,450 and a fair value on the last day of the year of $318,200. So we are going to look at the difference between the carrying amount or the amortized cost and the fair value. That differential is $3,750. In this situation, we actually have a gain. Okay? So our adjustment is going to be a debit to the fair value adjustment in parentheses trading. Recall that that is similar to a debt investment account. So we're increasing the value of our investment, and the offset is going to be a credit to unrealized holding gain or loss, but instead of dash equity, this is going to be dash income, and the reason that it's dash income is because it's actually going to be recorded on the income statement. And the thinking or the rationale behind why this type of security why the fair value changes are going directly into the income statement is because since the purpose of these securities is to generate profits on short-term pricing differences, and the likelihood that the company is going to hold on to this security for very long is not likely, and so therefore because it's going to be sold so quickly, right, which is automatically then any gain or loss is going to have a direct impact on net income, they say, you know what, just record any unrealized gain or loss also into net income. So that covers investments in debt securities. Now we're going to move on to investments in equity securities. So investments in equity securities represent ownership interests such as common stock, preferred stock, or any other type of capital stock. So an example of this would be Marriott buying McDonald's stock, or Marriott buying Apple stock, or Best Buy buying Target stock. Okay? When we talk about ownership interests, it can also include warrants, rights, and call or put options, but most frequently what we're talking about are buying other companies' common stock. The cost of equity securities that are purchased include not only the purchase price, but also brokers' commissions and other fees incidental to the purchase. Now, when it comes to equity securities, the classification and accounting depends on the percentage of the investee voting stock held by the investor. So the investor is the company that's buying the stock, and the investee is the company whose stock is being bought. So there are 3 thresholds that we look at when it comes to determining how we're going to account for investments in equity securities. If there is a less than 20% ownership interest, we are going to use the fair value method. And this is basically a method that assumes that the investor has a passive interest. Okay? They are invested in it, but they don't really have any significant influence or control. When the investment is more than 20%, but less than 50%, the equity method is used to account for the investment in the equity securities. And between a 20 and a 50% ownership interest, it is assumed that the investor has significant influence. And then finally, if a investment in equity security is more than 50%, that requires consolidation. And in that situation, an investor has a controlling interest because they own more than 50% of the company. So, when we have an equity security where our holding is less than 20%, we have said that the investor has little or no influence over the investee. So the investing company, the investor, is going to value and report the investment using the fair value method, either as available for sale or trading securities. Now, keep in mind, a few minutes ago, I talked about how because held to maturity securities have an ending maturity date, and equity securities never have an ending maturity date, that equity securities can only ever be available for sale or trading. So, available for sale securities are going to be recorded at cost upon acquisition. So, their journal entry is going to be a debit to equity investment and a credit to cash. That is very similar to an available for sale security that's classified as a debt instrument, the only difference being that instead of debiting equity investment, you're debiting debt investment. Then, periodically, the company might declare a dividend, and because you own shares of common stock, the company, aka the investor, would be entitled to dividend payments. So, when there is a dividend payout, you're going to debit cash and credit dividend revenue. And then finally, you're going to record any unrealized gains or losses at year-end, just like the accounting of available for sale debt securities. And so recall that under available for sale debt securities, any changes in the fair value are going to be recorded in other comprehensive income. So on the next slide, I have an example. On January 31st, 2013, the Beatles sell all of its Michael Jackson common stock, receiving net proceeds of $287,200. The cost of the common stock was $259,700. So Our sale is going to be as follows. We're going to record cash of the $287,220. We're going to credit our equity investment for $259,700, and then we have a gain on the sale of investment of $27,520. Again, for this example, let's pretend that there was no unrealized loss previously recorded in other comprehensive income. We will look at how to transfer between unrealized and realized in a few more slides. Now, what happens when we have a holding of less than 20%, but it is a trading security? So the accounting again here mirrors available for sale securities, except for the unrealized holding gain or loss portion. Instead of that going into other comprehensive income, we put it in directly into the income statement, which is how we treat trading debt securities. Then finally, what happens when we have a holding between 20% and 50%? So more than 20%, but less than 50%. So ownership of less than 50% does not represent legal control, but does allow an investor to exercise significant influence over operating and financial policies. Under the equity method, we are going to record the investment at cost of the shares acquired, but we are going to adjust it each reporting period for changes in the investee's net assets. The investor's proportional share of the earnings or losses is going to increase if it's earnings, or decrease if it is losses, the investment's carrying amount. And any cash dividends that are received by the investor from the investee are going to decrease the investment's carrying amount. What that essentially is doing is transferring a portion of the investment, that's usually a long-term asset sitting on the balance sheet, from a non-liquid long-term asset into another asset, cash. So let's look at an example here. So on January 2nd of 2012, One Direction acquired 48,000 shares, which represented 20% of New Kids on the Block common stock, at a cost of $10 a share. So this is a holding between 20 and 50%, so we are going to use the equity method. So the first journal entry then for Part A is going to be to debit the equity investment at cost, which is the 48,000 shares times $10 a share, or $480,000, and to credit cash for $480,000. Then, for all of 2012, New Kids on the Block reported net income of $200,000. So, the equity method basically says you are going to increase your equity investment by your proportion of the net income. Okay, so in total, New Kids on the Block reported net income of $200,000. However, One Direction only owns 20% of that company, or of New Kids on the Block. Therefore, One Direction's proportion is not $200,000, but is $40,000. So the journal entry is going to be a debit to equity investment, $40,000, and a credit to investment gain, or earnings in equity. C, on December 31st of 2012, the 48,000 shares of New Kids on the Block has a fair value or a market price of $12 per share. Because we are using the equity method to account for this investment, because it's between that 20 and 50%, we have no entry to book for Part C. Now, if this was a fair value problem, we would adjust the debt investment up or down to fair value. but because we're accounting for this using the equity method, no entry is needed. Then, on January 28th of 2013, New Kids on the Block announced and paid a cash dividend of $100,000. So again, $100,000 represents the total dividend. One Direction is only entitled to 20% of that. So the entry is going to be a debit to cash of $20,000 and a credit to the equity investment for $20,000. And then for the year 2013, New Kids on the Block reported a net loss of $50,000. So losses reduce the equity investment. So $50,000 is the total amount. One Direction only has to take 20% of that. So the journal entry is going to be a debit to investment loss, or equity and earnings, and a credit to the equity investment. So that's going to reduce the value on the balance sheet. And then for F, on December 31st, 2013, New Kids on the Block have a fair value of $11 per share. Again, that is not relevant because we are not using the fair value method. We are using the equity method. So here is a summary of what those journal entries should look like. And then finally, when we have a holding of more than 50%, this is going to result in a controlling interest where the investing corporation is referred to as the parent and the investee corporation is the subsidiary. Under the appropriate accounting for this, you're going to prepare consolidated financial statements using the equity method. However, we are not going to be going over this in this course. That is, consolidations is a topic for advanced accounting courses. So then the final area that we want to cover when it comes to investments is around investment reporting issues. And so we're going to go through the following 5 investment reporting issues. They are the fair value option, the impairment of value, reclassification adjustments, transfers between categories, and controversy around fair value. So the first is the fair value option. So companies have an option to report financial instruments at fair value regardless of their intent. So if you recall back to the beginning of the slides, I had mentioned that for available for sale securities and for trading securities, they are going to be recorded initially at fair value. However, for held to maturity securities, they get recorded at their amortized cost or their historical cost. So companies do have an option to record all of their investments at fair value, and that option is applied on an instrument-by-instrument basis, but it has to be made or elected at the time that that instrument is purchased. And once a company says, hey, I'm going to value this at fair value, it must stick to that measurement technique for the duration of ownership for that interest. Now, proponents of this fair value option say that it improves financial reporting because fair value is closer to current market values, right? It's a more accurate picture of a company's current financial standing than using historical costs that could be years old. However, people that are against this policy say that it is inconsistent with reporting because the election is allowed to be made on an instrument-by-instrument basis. 2 identical instruments could have one reported at fair value if the fair value option is elected while the other is reported using amortized cost. So where you would see this happen is if there were 2 held to maturity debt securities, and because they make this election on an instrument-by-instrument basis, a company elected for one of the instruments to be reported at fair value, while the other one, because it was a held to maturity debt security, would be recorded at amortized cost. A second consideration is impairment of value. And for impairment of value, companies have to evaluate each investment at each reporting date to determine if an impairment has occurred. If there is a loss in value that's deemed to be something other than temporary, it is required to write down the cost basis of the individual security to a new cost basis. Now, the problem with this approach is that it can be very subjective because determining that a security is or that the loss of value in a security is other than temporary is very much a judgment call. Now, when a company does decide that it needs to write down an investment, it is accounted for as a realized loss. And the thinking behind that is because this instrument has lost value and it's not determined to be temporary, that recovery is so unlikely that in order to be more conservative, they need to record that loss in the P&L immediately. So when determining impairments for debt securities, we use the impairment test, which you would have covered last semester in your Accounting 310 class, or whenever you took Intermediate Accounting 1 and covered impairment testing with long-lived assets. And for equity securities, it's a less precise measurement test, but basically any time the realizable value is lower than the carrying value, you need to consider impairment. Next, we want to take a look at reclassification adjustments. Now, reclassification adjustments are when we have a security that previously had some unrealized gain or loss recorded in other comprehensive income that now becomes realized because we have sold the security. How we deal with this is via a reclassification adjustment, and this is to help us avoid any double counting. Now, it's also important to remember that a reclassification adjustment is only needed when we have available for sale securities. And the reason for this is that held to maturity unrealized gain or losses are not recognized, and trading security unrealized gains or losses are already recognized in net income. So when we realize them and they go to net income, the unrealized portion has already been recorded in net income, and therefore there's no potential for double counting. So let's take a look at an example. Tim McGraw has the following available for sale securities at the end of 2014. So Tim McGraw has investments in Keith Urban and Tricia Underwood. The cost of those investments is $80,000 and $120,000 respectively, and the fair value is $105,000 and $135,000. So as a result, we have an unrealized holding gain of $40,000. So the statement of comprehensive income for 2014 is going to look like net income of $350,000, and then other comprehensive income, the holding gain of $40,000, gives us total comprehensive income of $390,000. Now, during 2015, Tim McGraw sells the Keith Urban stock for $105,000, realizing a gain of $25,000. Additionally, the fair value of Tricia Yearwood stock has appreciated to $155,000. Now, if all we did was say, oh, okay, Tim McGraw got sold and recorded gain of $25,000 in net income, keep in mind that we already had recorded an unrealized gain related to Keith Urban in 2014. So, what we're going to do is, Tricia Yearwood is the stock that we still have. Its fair value has now gone up to $155,000. So in total, compared to the cost, we have an unrealized holding gain of $35,000. Now, keep in mind that our previous unrealized gain was $40,000. So instead of recording an additional gain, we actually need to record an unrealized holding loss of $5,000. That will then allow us to record a $25,000 realized holding gain for Keith Urban for a total holding gain of $20,000. What this is going to look like then from the comprehensive statement of income, or statement of comprehensive income, depending on how you want to say it, is our net income is $720, right? We had a holding gain that arose during the period of $20,000. That was the increase in Tricia Yearwood stock. We had a reclassification adjustment that was for Keith Urban. So the net of those two is that $5,000 that I was mentioning on the previous slide. So this gives us now comprehensive income of $715,000. So again, remember that in the previous year, right, Tim McGraw reported a $40,000 holding gain. But now, on a cumulative basis, that holding gain is only $35,000, and therefore he needs to report an overall loss of $5,000 in the unrealized holding gains and losses. Another consideration that we need to think about, or another reporting issue, is transfers between categories. So transfers between available for sale to held to maturity, or held to maturity to available for sale, are going to occur at fair value. Now keep in mind that one of the ways that we distinguish between different types of securities is management's intent, right? And that is not only their ability, but also their strategy. But it's possible that their strategy, or what they're thinking, may change over time, and therefore it is possible to transfer between categories. So when we do need to transfer between categories, we do that at fair value, and that is to make sure that a company cannot omit the recognition of fair value simply by transferring securities to the held to maturity category. And then finally, we have fair value controversy. And so the fair value controversy really kind of stems from three components. One is measurement based on intent. And I mentioned before that, there's quite a bit of subjectivity when it comes to investments. And one of those areas of subjectivity is intent of management, right? Because it's a major driver for the classification of debt securities, it means that the same security can be reported differently depending on the intent of management. There's also controversy around what is called gains trading, and that is where companies will sell their winners to be able to report gains in income, while they'll hold on to what we call their losers, or their instruments where the fair value is maybe less than amortized cost, but yet the company can make an argument that the lower value is temporary and therefore does not need to be impaired. But when companies sell their winners and hold on to their losers, what it can result in is cherry picking, which is also known sometimes as gains trading. And then finally, liabilities not being fairly valued. So if an asset or an investment, which is what we've been talking about tonight, are reported at fair value, why are liabilities not reported at fair value? So oftentimes liabilities are reported at historical cost or at present value, and since shareholders' equity is basically a plug between assets and liabilities, the equity balance is distorted because you have your assets at fair value, your liabilities at historical cost or amortized cost, and therefore, because the measurement techniques are different, your equity balance is distorted. So this next slide is just a summary of the different types of investment securities and then their applicable balance sheet and income statement recording.